morning, friends. And uh, as we begin 2016, I've always wondered the consistency of Kotak Institutional Equities to keep the title of the conference as Chasing Growth. So the question in my mind is, first of all, is the growth here or no? Because, and I'm not casting any uh, aspersions on the CSO at all, but we seem to be growing at 7.5% as per the reported numbers. And therefore, I think KIE seems to have done a wonderful job statistically that over the last few years, it has managed to get growth, at least statistically. So the question, therefore, in everybody's mind, friends, is what's really happening to Indian growth and how do we grow sustainably from here? And that is the key question in everybody's mind. And as I think about this, the few thoughts which come to my mind are first, why is it that if we are growing at 7.5% or around, most of the numbers of corporate India and the earnings of corporate India not reflect that statistical reality? There are many answers to that, but amongst the few which come to my mind are first, for the first time in Indian history, we are seeing the level of real growth being higher than nominal growth. Most of the time, if you looked at the Indian history, if you had a 7 to 7.5% real growth and you took inflation, WPI, CPI historically was not very different. You came to a nominal GDP growth of around 13.5%. And therefore, a 7% growth translated to a nominal growth of 13%. This time around, on the basis of the last data, the 7.5% or 7% real growth is translating to 6% nominal growth. Therefore, what we eat and feel every day is nominal growth. And that really is the question. Therefore, a 13% nominal growth economy seems to be growing at 6%, which is why this perception that while we're seeing growth on real terms, and we can debate 7.5, 7. The old series was about 2% lower, so I'm not saying we are at the old series, but a nominal GDP at half the rate at which we used to grow is one of the issues. The second issue, as I see it, is a very dramatic difference between WPI and CPI, and which is a delta of 700 basis points. And this is huge by any standards or, again, parameters which I have seen, at least in the Indian context, over a long period of time. Therefore, this 700 basis points difference is then a key issue that what should the benchmark be for considering the levels of inflation. Historically, till Dr. Rajan took over, most of the monetary policy as we understood used to be of WPI. And I wonder that if the benchmark for monetary policy was WPI, what would be the level of interest rates in the Indian economy today? So that is an important question. The consumer sees CPI. The producer in India is seeing WPI. And this wide variation, again, is creating a significant disconnect between producers and consumers. Having said that, from the point of view of savers, who are more on the lines of consumers, this is, for the first time in Indian history, that the saver is seeing real interest rates on his or her savings. And this is a very significant factor. It has led to a dramatic increase in financial savings domestically, and if continued for a long period of time, I think it should see significant results for the banking industry, mutual fund industry, the insurance industry, and every form of asset management in the years to come. And in a way, it diverts flows away from what historically has been the most popular area, which is gold and real estate. So let's see how far this goes. It is also having a big challenge on the whole budget-making exercise with reference to the GDP deflator in terms of how do you collect your taxes. So that is the other issue which is coming up. And of course, when I'm speaking this morning, I need to touch a bit on the financial sector in the Indian context, which is on the minds of most of us. Frankly, friends, what is happening right now in the financial sector, for some of you with whom I've had a chance to talk to over the last 2 or 3 years, this is not a surprise. The challenges on the stock of stress have been there for a long, long time. And effectively what has happened is, if there was stress in the system, say take back, I think it started somewhere around 2009-10, which is about 6 or 7 years ago. And then you had a situation where banks were basically postponing some of their problems by kicking the can into the future since then. And the beauty is that when a borrower is leveraged and doesn't have much choice because he cannot repay, he has to accept the terms of the bank, ready to restructure or postpone the loan at terms which make sense for the bank. So normally most of these loans got extended for a period of 5, 6, 7 years at interest rates of 13 to 14%. So in a period of 6 to 7 years, a 100 rupee loan has effectively doubled. So it has become 200 rupees. At the same time, the underlying assets into which the borrower has put his money, in many cases there was no assets as well, but keep that aside. The underlying assets into which the borrower has put money, thanks to the discussion we've been having on WPI and extremely low levels or negative levels of inflation, the asset values have not gone up. And effectively, the ballooning of the debt over the last 6 or 7 years on the one hand, and virtually very low inflation on asset values has in fact dramatically expanded the whole. Therefore, the problem which you're seeing today is now what was a 100 rupee problem has become a 200 rupee problem. The underlying assets have not appreciated. In many cases, because projects have been stuck, the underlying asset values may have actually come down. And therefore, if the underlying asset value was, say, 120 against a 100 rupee loan in 2009-10, we are now staring at a number which is underlying asset value somewhere in the late double digits and the value of the loan at 200. So this is the issue about what has been a bloated situation, and many of the investors here will keep in mind that a significant part of the loan growth in the financial sector in the last 6 or 7 years also came because a lot of loans were being effectively rolled over. So you saw a wonderful loan growth and you saw wonderful earnings because the banks were getting very high interest rates, but effectively we were bloating the balance sheet and the loan book of banks without underlying performing assets. And this is the real issue, friends. And I see a lot of talk from various sources, even now, oh, we are being too harsh, we need to give people more time. The issue is we better tackle it when still the loan is 200 and not wait when it is bloated even further and then have an even deeper surgery. So this, I think, is one of the major issues on the financial sector side. And of course, inevitably, you have a situation of the industry structure where 70% of the banking industry is state-owned. There's a 30% private sector. And while I don't have the exact statistic, because there is no statistic available of the different kinds of stress in the Indian banking system, but if I have to sort of look at the broad number, my sense is the stress may be against 70-30, more like 80-85 on the side of the public sector banks, and maybe around 15 odd on the side of the private sector banks. And I've often been asked, which are the different aspects in which stress is currently sitting on the balance sheets of banks. And I think it is sitting in different forms. It's sitting in the form of NPLs, restructured assets, um, some of them parked in ARCs. Another very big item, which has still not been the subject matter of the analyst community and investors either, is the whole area of off-balance sheet exposures. There is a significant off-balance sheet exposure which is sitting, which at times, which over time will run the risk of coming onto the balance sheet. And then finally, there are two other R's in addition to restructuring, which have got popular with banks over the last few months, if I can say. One of them is known as an R for rectification, which is a very popular program for banks to push some of the loans out, which is essentially under a corrective action plan, and rectification does not get reported, does not get disclosed to the markets, but effectively postpones the loan for a period of time. And the second popular R in recent times is rotation. So loans get rotated. I am not very familiar with the technology, but it is quite widely prevalent in the industry. But these are the other two R's, which are, again, the bane of the financial system. Moving on to the positive side of the financial sector as I look at it from here. Friends, despite the fact that you've seen this issue about stress getting so bloated, my personal view is most of this is still stock. The flow is much better. And the good news is the flow is better because you don't have an investment cycle. So maybe this linked to that, but the fact of the matter is the flow does not look anywhere near as overwhelming as what we have seen on the stock. And I do believe that this is an opportunity for banks or financial institutions and intermediaries to really use this opportunity as I see a transformation happening across the three key intermediation roles in financial services. The first being the whole transaction space, which we are seeing the whole digital footprint getting built at a phenomenal pace. And financial intermediation in the transaction space or the broad payments and collections in any form of transaction will grow dramatically, albeit at lower margins. So I'm sure Vishal has a lot to say on some of this as he serves global customers. But the transaction space in financial services will grow rapidly, but at lower margins. The two areas where I believe, I think financial intermediation across the spectrum will continue to play a very major role is in the area of risk. And I must say that if there's one thing which I find pretty common across financial industry worldwide is the challenges or inability to measure and manage risk and not being able to really think about how to evaluate risk, which is at the heart of financial intermediation. Any leverage institution at a level of 10:1 leverage. You know, we bankers have completely double standards. When we think about borrowers to whom we decide to give money, at least some of the bankers, they look at the leverage ratios or the debt equity ratios of the borrowers. And moment it starts getting about 2, 2.5, we say, oh, now this is getting over leveraged. But for us, 10:1 is okay. And the banking industry has been lucky that investors have been kind to continue giving money to what are very highly leveraged institutions, and therefore an extremely important responsibility for banks where capital is basically less than 10% of the total balance sheet to play it well. Leverage is both virtuous and vicious. Therefore, the role of risk management in the intermediation process will be one of the most crucial roles for any financial intermediation, irrespective of any technology which comes into play. Because finally, statistics, analytics are important, but models can be wrong, and there will always be a value for judgment. And finally, on that note, the third and most crucial part of financial intermediation is what I call as knowledge and skill. And I see many investors here who still continue to get discretionary money. If knowledge and skill was not important, all the money would have been going only to the dumb ETFs. Therefore, it is in our common interest that investors continue to value knowledge and skill as an important aspect of financial intermediation in the years to come. And ETFs are not the answer to replace judgment and insight. So with this, friends, I do believe the financial services intermediation industry has an extremely interesting role, different in the future, but combined with extremely high responsibility, because we are a high-octane dynamo which runs a 10:1 leverage. So on that happy note, I will now hand over the proceedings for what I think is going to be a wonderful 3 days from our institutional equities team. And I'm really delighted and honored on behalf of Kotak that all of you have decided to participate in this conference. A very personal thank you from me and all my colleagues to both investors and companies and speakers who have come and agreed to participate in this very important annual event of ours. Thank you very much, ladies and gentlemen.